content of this podcast is produced for entertainment purposes only and is for informational and educational use. It does not constitute financial or investment advice. You should not make any financial decisions based on the information provided without consulting a qualified professional. All opinions expressed are solely those of the host and guest and do not reflect the views of any company or organization. The hosts and or guests may currently own, have previously owned, or intend to own securities discussed in the content. The content produced here belongs to Daniel Andreev of 18 Degree Journal and cannot be reproduced or used without prior permission. We do not wish for this content to be used for AI training and do not give such permissions. WriteUp, MLCI post-tender updates. Let's talk a little bit more about the skeleton in the closet. So, hey guys, I think long overdue. As many of you know, the MLCI arbitrage is done. The post-tender has settled, and at least to my approximation, most of the shares should have settled. Here to give you an update and a bit of what we missed out in part one, especially about some of the liabilities that are in MLCI's books that need to be discussed. For those that missed part one, I'll link it down below. And as always, please check out part one, but also disclaimer that, again, this is for educational and entertainment purposes only. I currently hold a position. I may sell it at any time, and please treat this as a educational experience. So results of the tender. So tender offer expired February 2nd at 5 o'clock, 2026. And as I expected and wrote last time, that it was indeed oversubscribed. So all expected shares, which 1,590,006 shares were bought roughly at $9.43. Well, not roughly, at $9.43 for cash. This means the proration factor was 28.23%, meaning that 28.23% of your shares were bought by the company. The rest were returned to you. And for many of those who were returned at a steep discount price than to what those who bought in January at $8 would have got. So the remaining 72% you would have gotten out today, and probably at a discount of about 25% or so downwards since that date. Again, depends what you take, where you bought, but approximately that. Shares now trade lower than before the merger. At least that's what I looked at. Overall, clean execution by management. It shrinks the float nicely, so 12% of the share count is gone, which could be a tailwind if sentiment does flip. However, I understand that there's a short, there's a diverse shareholder base and it's hard to get the float buy it all back, but I would have explored, as a shareholder, you would have much preferred them buying at current prices than spending $9.43. But what can you do, right? According to management, they did buy below their stated book value, but their stated book value does have intangible assets in there and some goodwill. So again, take that as you will. Hopefully you have come ahead. If not, maybe a lesson for risk oversubscription. But in my opinion, even if you're left with the shares now, the business is still looking very, very promising and very interesting. Again, in my opinion. So I think last time I didn't really talk about the industry models and how they can look. So I think to better understand the advantages that MLCI has, we need to look at the high level of alternative business models in a similar business and understand their advantages and disadvantages. I want to give a shout out to Red Deer Investments. He runs a blog for great articles such as Kings Don't Buy Float and Trading Complexity for Capital Intensity in Life Insurances, for educating me, and a few other resources I found online, because without them, I would have been much more behind. So the story of the industry really blew up. Outside of the industry, at least, really blew up or gained attention post-2008 financial crisis, with the Dodd-Frank 2010 being a catalyst. During the restructuring and company wind-downs, many insurance liabilities and complex annuities were sold at steep discounts as credit cycles contracted. A few participating players, notably Apollo, scooped up those liabilities and assets and invested the proceeds in higher-yielding, higher-quality investments. This would look like the incumbent companies underwriting the new premiums at profitable levels, and instead of investing in traditional public bonds, finding alternatives such as private credit and higher-yielding bonds, compressed all due to financial crisis and euro crisis, etc., and growing their asset bases. Some of these companies would buy other companies to grow assets, while others would position themselves as the new management of these assets and guide them into profitability. To basically simplify all the gibberish I just mumbled, the goal is to chase the float, aka the endless permanent capital that you could reinvest at higher rates than you're owning to borrow it. If you really simplify, there are only really two real ways to grow this business. Method one, I like to kind of call this the path-through method or the caretaking model, where you buy bulk flow from banks, institutions, and repackage those liability as loans or collateralized obligations and lend sell them. You can earn a fee for these services with some incentives as your execution, similar to the brain model that we talked about last time. The drawback, of course, is that the industry is super cyclical and no guarantee of constant business flow. So there's method two, which is similar to what Apollo does. I call this method more of a snowball method. You slowly grow organically by yourself, writing liabilities or annuities and matching them with other opportunities you write. As you can imagine, this requires necessary resources, necessary scale, and trusted personnel. Blackstone will be closer to method one, while Apollo KKR closer to method two. The department that fiddles or deals with this type of business anyway, so not the whole business, but components of them. Now, why this rush for growth, and why does it really matter for size and business models, etc.? So, unlike other business models, the small scale is a huge disadvantage. The smaller you are, the more resource and personnel needed to execute each deal, so your costs go up. Moreover, if you are small, each deal that goes wrong, aka a bad loan or higher liability than previously modeled, etc., can sometimes drag performance and lead to losses that are not absorbed by other deals. But okay, let's just ignore that. Let's look, why do we still care about the scale? Could you not just, have a tight ship and watch over your eggs and your baskets and you'll be full fine as long as they don't crack? Well, the revenue quality for this business is a lot worse in this industry than compared to others. Method one, you need a constant stream of deals and good credit environment to stay in business. You have no assurances that deals will keep coming, so your management fees could dry up at any moment. Moreover, unlike management companies that might earn, say, a 2% fee, like in private equity, here you earn a small 0.4% fee, so that means you need a massive AUM in order to make substantial profits. Companies do try to differentiate themselves and carve their own niche, and here it's done through complexity. Some players, in order to generate higher spreads, take upon themselves more risky types of activities. You will see an example below. And you might have guessed MLCI is a sort of trying to hybridize these methods. They don't have the scale to do method two properly, where they would originate their own deals and underwrite their own risk, but they're growing permanent capital base with their own management team. But they're super dependent on leveraging BC partners as that, so they rent, you could say, personnel requirements from them and act as if they're a scale player, meaning they only borrow or rent these resources when required and compound the rest. The risk is that without sufficient size, MLC is tiny, for lack of a word. Small mistakes and legacy liabilities that I will give more context on can overthrow the benefits of permanent capital. So I keep talking about these risks, legacy risks, so a bit more about these hidden risks. So in part one, I really focus on giving a high-level view of the business model and elements to understand this and assemble a simple model of the business. I think to understand the long-term risk of the business, we need to open up the muscle business and understand what makes it twitch. I was saying it before, but MLCI is transitioning from existing more complex annuities and transitioning to simpler annuities. Don't worry, I will explain. But the legacy annuities are quite the anchor for future prospects. So in May 2021, Mount Logan acquired Ability Insurance for $20 million, so $50 million that was in notes, $5 million was in stock, to transform MLCI into a platform for permanent capital. This transformation came with the inheritance of zombie risk that was hidden inside the liability of Ability Insurance. We can even go as far as to call it a cancer or tumor that they hope won't spread in order to enter the highly regulated industry and build out their insurance vehicle with the size ability given. So, I don't know if I'm making much sense, but stick with me. So, I'm using a lot of these scary imagery of zombie, cancer, tumors, but what is this risk? Remember in part one, we talked about the annuities business and how the muscle, the SRE business, earns its profit from the difference between its obligation for the annuities and the money it earned from investing principals from the annuities. Well, not all annuities are created the same. and some are a terrible idea. When MLCI bought Ability Insurance, they inherited complex long-term care LTC policies. These policies are designed to cover the cost of service that aren't usually covered by regular health insurance or state and federal services. Specifically, these policies help cover if you can't perform two of the following: bathing, dressing, eating, toiletries, continence, and transferring. Transferring meaning getting in and out of bed. Triggered by receiving a doctor's certificate or by being diagnosed with severe cognitive impairments, so Alzheimer's, dementia, etc. Payments begin after a person has completed a 30 to 90 day self-coverage period, again, depending on the policies, and the rest is covered by the insurance provider. These are exactly some of the more complex underlying than some players do. However, the liabilities inherited policies underwritten in the late 90s, early 2000s that severely underestimated the expanding life expectancy, rising medical costs, and assumptions that the clients would lapse in their required payments. And surprise, surprise, majority of the clients kept paying the payments, which means Ability was still on the hook for a lot of these liabilities. So every day a policyholder remains under the care, Ability Insurance gets charged. Of course, management realized this was a huge risk and counterintuitive for their business model. They had stopped writing or issuing more LTC policies and have reinsured their LTC liabilities. However, even though they've reinsured the bulk of their LTC risk, they still retain a small portion of the claims. And in Q3 of 2025, these retained claims were higher than expected, leading to, let's call it the back of 1.8 million leak of their boat, hit by unfavorable updates in their LTC Guardian blocks, what it says. So if we really break it down and look at it more, at the very same time as the underwriting of this legacy block, Mount Logan was squeezed with falling SOFR rates. This pressure is that the falling SOFR rates are used to write loans, usually variable loans as SOFR plus spread. So as the rates fell, the income from the investments also fell, creating two drags on their earnings, which is why they had such a one of the reasons they had such a massive loss. Now, before we move on, Mount Logan understood these risks and they acquired Ability Insurance and is restructuring the liabilities they underwrite. They no longer write, as I said, LTC policies. They're eagerly waiting for them to mature for them books and now write MYGA policies. As you can see in part 1 of the article, the model is predictable, mathematical, and profitable for MLCI. Ability Insurance would take in a lump sum, for example, 100K, and guarantee you fixed interest rates, for example, 5.5%, over a set number of years, say 3 to 7 years. The growth is tax deferred, and at maturity, investors can take their lump sum interest plus interest and roll it over. If the policyholder wants their money back before the lockup period ends, they need to pay a surrender charge of 7 to 9%, and most MYGAs allow policyholders to take, call it 10% of their money penalty free from each year for emergencies. For a deeper explanation, just look at part 1 diagram. The play here is simple. MLCI is rotating their LTC policies into new MYGA policies and trying to grow it so it overshadows the legacy issues. And, of course, this drag. So they will slowly return to a more healthy 0.7 to 1% range as these mature, as LTC policies mature. So if we look at the numbers, and in the previous article I gave really rough numbers without really going into details. This time I'll just give a little bit more just to get a clear picture. But again, these data is for September 2025. Take it all with a big grain of salt and do your own calculations. So total money under management now is over $2.1 billion. Fee-related earnings were about $9.3 million. Annual is estimated for Q3 run rate, and SRE fees were about $1.1 million. That's for the 9 months of January to September. I think it's important to highlight that the brain manages the muscle capital. So technically speaking, part of the portion is paying itself. So if that for this quarter was $1.6 million, that was according to the last quarterly reports. So it stays within the business. $680 million of the $1.1 billion under Ability Insurance is managed by the brain. Portfolio yield was about 7.4%, and as you know, they recently both got new debt securing an unsecured $40 million at 8%, and also bought back 12% of the company at $9.43 per share. Current debt is about $91 million, but that could have changed. Before we're back from the envelope calculation spirit, let's examine what this actually possesses. So the current market cap, say it's about $70 million. Cash on hand is about $151 million. It's important to note that this cash is mostly restricted for regulatory purposes to support insurance liabilities. Even when considering tangible book value, they range them approximately 61 to 66 million. So what's the catch? High cost of debt, as we said, is fine. Their yield is 7.4. They're being paying 8%. Uncertain LTC commitments and more complex corporate structure all justify discount from the market. However, today you're essentially acquiring a fee related business at a bargain with a lottery ticket attached for them to fix the SRE business. If management successfully executes their strategy, shifting to a better annuities and avoiding diluted mergers and acquisitions, you could see a company generating approximately $20 million in net profits, valued only at $70 million market cap. Again, a lot of ifs and whats and questions about the management, but the underlying value here is clear. Additionally, there's now a recurring revenue stream from a profit sharing agreement with Sierra Crest. The management expects to scale and could add to the bottom line of investments, pure margins for their fee brain business. Mount Logan has recognized approximately $300,000 to $400,000 for these for each quarter from Sierra Crest, and management does believe that this business is again growing. So some final thoughts. Hopefully this brings a little more context to the company. I didn't really go into depth about management. I think I'll save that for the next write-up if I do it. And hopefully if you have any criticism or ideas to add, I'll be all ears and you enjoyed it. So cheers.